Hello everyone. So we are group 16 with the member Nervasa, Ramos, and Fernandez, and our topic is all about master budget. So the objectives of this topic is to determine the expected income and expenses in a financial year. Second is to note the various components of a master budget and how are they prepared. And lastly is to know and explain the basic concept involving financial forecasting.
Here is the introduction for Master Budget. Master Budget is not actually one budget. It is a series of budget that will detail the sales, production, cash, direct material purchases, labor, overhead, and SGA budget. The Master Budget is also known as the Static Budget and Planning Budget. It is called the static budget because it determines both the cost per unit and the expected number of units to be produced and sold. And now, for budget building blocks, we have here the sales budget. In sales budget, we have here the production budget and the SG&A budget. And for production budget, we have here three components of this: materials budget, labor budget, and factory overhead budget. And for cash budget, we have here the budget income statement and budgeted balance sheet. And now for components of master budget, we have here the operating and financial. For operating, this includes components of the various pro forma financial statements, and we have here the sales budget, production budget, purchases budget, direct labor budget, overhead budget, and selling and administrative budget. And for financial, this includes pro forma, the cash budget, capital expenditures budget, balance sheet, income statement, statement of cash flows, and statement of retained earnings. While the operating budget focuses on the day-to-day operations and production activities of the business, the financial budget provides a snapshot of the company financial position, performance, and cash flow expectation. Together, these components create a comprehensive financial plans that guides the organization's activities and enables effective financial management. Sales budget. What is sales budget? A sales budget is the estimated number of units and potential income that a business hopes to sell in each time frame. Organizations usually track this either quarterly, monthly, or annually. What makes sales budget crucial? Sales budgets are crucial instrument for organizations to assess their entire performance and potential revenue from a given product. The sales budget plays a central role in guiding various aspects of business operations and financial management, making it a crucial component of the master budget. And now for example of sales budget here. Sales budget for the 3 months and quarter ending March 31, 20XX. We have here the estimated units for January, February, March, quarter total, and we added a month here, the April, same regardless of territory or customer. Estimated units for January is 30,000, February 28,000, March 33,000, and we added a month of April here, which is 32,000, and for selling price per units, they're also the same, $5. And for total estimated sales, how do we get this total estimated sales? We multiply the estimated units by selling price per units. Example for January, 30,000 times $5. And that's how we get the total estimated sales. And also for quarter total, as you can see here, 91,000, and we multiply this estimated units 91,000 by selling price per units by $5, so we get the total estimated sales or the quarter total for this. And the total annual sales in unit is 350,000.
Production budget is a written statement of how many units of a certain product an organization needs to manufacture to meet its projected sales volume. Businesses can prevent overproduction or underproduction, which can result in large financial losses by keeping an exact production budget. Product is also a function of the beginning finished goods inventory and the desired ending finished goods inventory. The budgeted units of production can be calculated as the number of units sold plus the desired ending finished goods inventory minus the beginning finished goods inventory. So to compute production budget, you need to add sales unit and ending inventory to get the total required units, and then subtract the value of required units to opening inventory to get the amount for production budget, production level or target.
So here is the example of production budget for the first quarter. So the estimated units for January to April is first 30,000, 28,000, 33,000, 91,000, and 32,000 respectively, and all of that is from the sales budget that was tackled earlier. So we will going to add a desired ending inventory. Just to give you all a heads up, this is just an assumption. So this is the 5% of the next month's unit sales. So first is 1,400, next is 1,650, then March 1,600 with a quarter total of 1,600. So the total needed unit for January is 31,400 since we add 30,000 and 1,400, and for the quarter total it is 92,600, add only 91,000 and 1,600. And for us to get the units to be produced, we will going to less or subtract beginning inventory to the total needed units that we get earlier. So that is 1,500 for January, 1,400, 1,650, and 1,500 respectively, and all of that is from the ending inventory of the previous period. So for January, units to be produced is 29,900. We will just subtract 31,400 to 1,500 to get that. And for the quarter total, it's 91,100. We just subtract 92,600 to 1,500. And we do have an assumed units for April, which is 34,500. So next is the direct material purchases budget. So a direct materials budget includes items needed to create, produce, or assemble a product. It details the quantity of each item needed to make a standard unit, and it also includes information on the average price of the necessary components. So direct material must be purchased each period in quantity sufficient to meet production needs and to conform to the company's desired ending inventory policies. So this is actually the total cost incurred by the company in purchasing the raw material along with the cost of other components, including packaging, freight, and storage costs, taxes that are related directly to the manufacturing and production of various products of the company. For example, components such as the screen, integrated circuits, camera, modules, and buttons are the direct materials involved in the production of a smartphone. So, units to be produced on this is from our production budget. So for January, it's 29,900. February, 28,250. March, it's 32,950 with a quarter total of 91,100. So we will going to add the desired ending inventory for this one, which is a 10% of next month's production. So 2,825 for the month of January. Then February is 3,295, March is 3,450, and the quarter total is 3,450, since that's the last month or March ending inventory. So to get the total units needed, add 29,000 to 2,825, so that will be 32,725 for the month of January, and for the quarter total, it's 94,550. And next step is that we will going to less or subtract it to the beginning inventory, and this is just again an assumption. For January, it's 3,130. So if we subtract it to the total units needed, that will give us an answer for the finished units for which purchases are required, which is 29,595. And for the quarter total, it's 91,420. So we still need to get the total pounds to purchase of the raw material. So we will be needing to multiply the finished units to the pounds needed per unit, and this is the one that is on the notes earlier. So it's 1.1, so multiply it to 29,595, that will be 32,554 and 50 cents for the month of January. And we will going to multiply it again by the price per pound of the raw materials, which is 2.30. So after we multiply that, we will going to get, or we can get, the purchase cost of the raw material, which is for the month of January, it's 74,875 and 35 cents, and with a quarter total of 231,292 and 60 cents. So for the next budget, that will be direct labor budget. So direct labor budget is used to calculate the number of labor hours that will be needed to produce the units itemized in the production budget. A more complex direct labor budget will calculate not only the total number of hours needed, but will also break down this information by labor category. So this is the example of the labor budget. So we still need the units to be produced from the production budget that was tackled earlier. We will be needing that to multiply it to the standard hours allowed, which is 0.025. So if we multiply 0.025 to 60, that will be 1.5 hours. So if we multiply it to 29,900, that will give us a total of 747 and 50 cents budget hours using the estimated production. And we needed to multiply it again to the average rate per hour, which is, for example, it's it's $14. So if we multiply it, that will give us a budget direct labor cost of $10,465 for the month of January, and for the quarter total, it's 91,100 multiplied by standard hours allowed of 0.025 or 1.5 hours equals the budget hours 2,227 and 50 cents. Multiply it by the average wage rate per hour of $14, which has the budget direct labor cost of $31,885. So that's basically how we compute the labor budget. Next budget will be the factory overhead budget. So the factory overhead budget should provide a schedule of all manufacturing costs other than direct materials and direct labor. Using the contribution approach to budgeting um, requires the development of a predetermined overhead rate for the variable portion of the factory overhead. So to compute this one, actually we're still be needing the units to be produced, which is from the production budget. That's why we really needed to get the production budget right, because if you computed that specific budget incorrectly, then the other budget will not um, be computed correct also. So the overhead is a part of manufacturing costs. We will use algebraic expression to compute this, which is y equals a plus bx. Y equals a plus b times x. So this is our formula to get this. Being your mixed cost, A equals fixed, then B is equals to variable cost, and X is the estimated machine hours. So still, we will use the, again, units to be produced from production budget. So the another assumptions here in the overhead budget are the following, which is this: overhead items. So the components under overhead items is depreciation, indirect material, indirect labor, utilities, property taxes, insurance, maintenance. So if this is our components, this Y will be our dollar cost. So to compute this, let's start on the estimated machine hours because we will be needing that. That's the X. So for the month of January, it's 29,900. We will be needing to divide it to the units produced per machine hour, which is 10. This specific amount or value is just an assumption. So if we divide it, so if we divide 29,900 to 10, that will give us a total of 2,990. And for the quarter total, it's 9,110. So let's move on this one to get all of this Y variable. So for the depreciation, we do have it just a fixed cost. It's just fixed. We don't have it as a variable. So to get that, just put it on this when all of it is 1.7 only since it's just fixed. And next is indirect material 0.2. So to get this, we will going to multiply x to, we will going to multiply b to x, and that will give us a total of 598. So 0.2 multiplied to 2,990 is equals to 598. So that's also the same here in February, March, and quarter total. Next is this indirect labor. So to get the indirect labor for the month of January, so to get the indirect labor for the month of January, we will just be needing to, here, A is equals to fixed, which is 6,000, plus B, 1.5, multiply it to the estimated machine hours for January, which is 2,990, to get the total of 10,485. And for Y, of February, just again 6,000 plus 1.5 multiply it to 2,825. Then total is 10,237 and 50 cents. So for the utilities, it's just the same. A, which is the fixed of 500 plus 0.1 from B variable, multiply it to 2,990 of the, which is X estimated machine hours, will be 799,000. So that's how you get this 3 months. Next is for the property taxes and insurance. It's just fixed only. Therefore, you'll just be needing to copy that for all of the months, and then add it to get the total of 1,500. Then the maintenance will compute it as follows: A plus B multiplied by X equals 1,472. And after that, we can get now the total overhead costs by simply adding all of this value. So 1,700, 598, 1,485, 799, 500, 450, 1,472 is equals to 16,004 for the month of January, with a quarter total of 48,306. But for this one, we can see, but for this one, overhead budget actually needs a actual cash flow pertaining to our overhead, which is we need to have a cash outflow, because in this overhead items, there is one that is non-cash, which is the depreciation. Because this is an allocation of our depreciable costs. Therefore, we need to subtract this depreciation of 1.7 to our overhead costs to get the total cost net of depreciation. Because again, it's a non-cash. So to get that is 16,004 minus 1.7 is equals to 14,304. And for the quarter total, 48,306 minus 1.7 is equals to 43,206. So that's how we get, or that's how we compute the specific budget.
SG&A budget includes all non-production expenses incurred by a company in any given period. It includes expenses such as rent, advertising, marketing, accounting, litigation, travel, meals, management salaries, bonuses, and more. And for the example, in this instance, our selling administrative expense are supplies, depreciation, miscellaneous, compensation, salespeople, and administrative. And also, we have here non-cash expense, as you can see in the note, because again, we have the depreciation. So, after you get the total selling and administrative expenses, ibawas mo si depreciation na 500 for you to get the total cost of selling administrative net of depreciation, because this will be relevant in our cash budget. So as you can see in the note, we will need the actual cash outflow for purposes of our financial budget in cash.
Cash budget. It is an estimate of a company's cash flow for a given time frame is called cash budget. This could pertain to a budget that is weekly, monthly, quarterly, or annual. This budget is also used to determine if the organization has enough money to fund operations for the specific period of time. Companies use sales and production forecasts to create a cash budget, along with the assumptions about necessary spendings and accounts receivable collections. A cash budget is an estimation of the cash flows of the business over a specific period of time. This budget is used to assess whether the entity has sufficient cash to continue operating over the given time frame. A company assesses its finances to determine how much income it will have in the next 3 months from its outstanding accounts receivable, cash, and other asset sales that will occur and close within the 3 months. It also includes an existing cash balance it can roll forward. To perform a cash budget analysis for the next 3 months, the company records the amount of these assets and obligations. The company adds its assets and obligations over the assessed period, and the resulting figure reveals the company expects to be able to afford its operating expenses without additional cash injections. Its finance staff's projects the company can complete the quarter with a new cash reserve balance, which is calculated by subtracting its total obligations from its total assets using the formula.
So this is the last budget that we will going to tackle, which is budgeted financial statements. So the importance of budgeted financial statements lies in guiding operational decisions related to raw materials and staffing. And to assess the success of plans, individual budgets are consolidated into pro forma financial statements with elements derived from the master budget. So we do have two financial statements here. First is the budgeted income statement. So this statement uses much of the information previously developed in determining the revenues and expenses for the period. Next is the budgeted balance sheet, which is this is actually just a completion of the income statement. So for this specific examples, we do have the income statement. So the Lewis and Clark Corporation budgeted income statement for quarter ending March 31, 20XX. Sales will be $455. So that is from the sales sheet. So all of the given here is on our previous budgets. So next is the sales discounts. This is from the cash collections that was, I think, tackled earlier. Then next, to get that is 455 subtract to 2012 is our net sales of 452,088. Next is cost of goods sold. This is from our projected balance sheet. Actually, we do have projected balance sheet here, which is this one. This is from the balance sheet of the previous year. So that's it. So cost of goods sold 48, finished goods 48, cost of goods manufactured is 308. So we will going to get a gross margin of 143,745. For the expenses, uncollectible accounts expense 2,184 with S&A expense 57,550. And for the income from operations, it's 84,011 minus add the 240 from the cash budget. So that will give us 84,251. So income taxes for this one is 33,700. We just assume that the rate is 40%. So 84,251 times 40% is 33,700. Then That's why our net income right now is 50,551. So as you can see, we do have like a note column here, and that is needed for us to know where we can see all of these values. So note A, from note A, because we do have here note A and note B. So for the note A, we do have beginning finished good units, production, units available for sales, and then finished goods units, cost per unit, material conversion, and cost ending inventory. And all of this also from the production sheet and from sales sheet. And for the note B is the total sales, credit sales, not taking discount, potential bad debts, estimated uncollectible, and estimated bad debts. So actually it is on the cash receipts budget here, but we actually didn't tackle it more since this is under the cash budget. Like, for you to get all of the details here in the cash budget, you needed to go first and compute the cash receipts, cash disbursement, cash accounts receivable, and cash accounts payable. So next will be the budgeted balance sheet. So this is the budgeted balance sheet of Lewis and Clark Corporation for the quarter ending March 31. So for the assets, current assets is cash, accounts receivable, less allowance for collectibles, and then inventories, which is raw materials and finished goods. And investment, so that is all of our current assets. That is from the cash sheet, from COGS, and from income statement. So total current assets is $1,116.912, and non-current assets includes property, plant, and equipment, subtract to accumulated depreciation, which is from note A and B here. Note A is beginning balance, then purchase new machine, and ending balance. This is from the projected balance sheet that I showed earlier. So that is 39,800 here. Note B is accumulated depreciation here, the beginning balance, factory depreciation, S&A depreciation, and ending balance. So this is from the overhead, projected balance sheet first from overhead and from SG&A. All of this was computed also earlier. So that is 96,600. So if we subtract that, that will give us a total of $301,400. So the total assets will be $116,912 plus $301,400 is $418,312. Next is liabilities and stockholders' equity. So we just have two accounts, which is the accounts payable and income tax payable. So accounts payable is 50,254 and the income tax payable is 33,700. And that is actually from our income statement, so that can give us a total of current liabilities of 83,954. Then lastly is our stockholders' equity, which is common stock and retained earnings. Common stock amounts to $180, and for the retained earning, it's $154,358. That can bring us a total of stockholders' equity $334,358. So the retained earnings is from note C, that is beginning balance from projected balance sheet. Add the net income, which is from income statement, that can bring us an ending balance of $154,358. So total liabilities and stockholders' equity is $334,358 plus $83,954 is $418,312. And as we can see, it is balanced. It's the same amount. Therefore, we do a correct computation for all of these budgets. So that's the all components. That's all the components of master budget. So to finish our report, we can see here first the solution strategies for all of the budgets that we tackle. And then the conclusion for our topic is that a well-prepared master budget can act as a guide to help managers align activities and resource allocations with organizational goals, a tool to enhance conduct of the managerial functions of planning, controlling, problem solving, and performance evaluating, a basis on which to sharpen management's responsiveness to changes in both internal and external factors, and a model that provides a rigorous view of future performance of a business in time to consider alternative measures. So, just to finish this specific topic, the reference that we use to get this is actually the book of Kinney and Rayborn, Cost Accounting Foundation and Evaluations, the 8th edition. So that's all for today. Thank you all for listening, and I do hope that you learned something on this specific topic, which is master budget. So thank you.